Talk about a rough day for Tesla stock. Ladies and gentlemen, Tesla closing down over 5.5% today. At one point, we were at $225 per share in pre-market, and we just closed at $210. Okay, that's a crazy, wicked move for any given day, let alone today, which you really didn't have much that actually happened. You had some Fed speakers with the Jackson Hole Economic Symposium, really bullish Fed speakers, in fact. There wasn't much to not like. Some Fed officials did express a little bit more caution on the economy. I believe it was Fed Harker says the unemployment rate is probably going to go close to 5%. Like, that's kind of negative. That's getting a little too close to recession for the market's comfort. But as a whole, there wasn't like one thing that happened today that caused today to be so rough. Really what it is preparation for Jerome Powell tomorrow. Now, we will talk about what to expect tomorrow from Powell, what I think we're going to get from Powell, and what could potentially happen next. I want to preference this video with saying the last two Jackson Hole events, the speeches we have got from Powell, have in the short term had a little bit of a positive effect, especially last Jackson Hole. Markets went up for a little bit following Powell's statement. You actually seen a little bit of a bounce here. But the last 2 years, 2023 and 2022, you have ended up selling off and going into a correction afterwards in the next weeks and months following Jerome Powell. Back here in 2022, you sold off literally like on the day of the Jackson Hole speech and ended up falling from this high to the low about 19%. And that's when you hit that October 2022 low. And yeah, that's been the bottom ever since. But last time when we peaked in August, we ended up falling about 10.5%. Well, now we're back up to almost highs again, right? Almost new all-time highs. And perhaps we could see a little bit of selling pressure with this Jackson Hole event as well. It doesn't necessarily need to even be bad. Like, I don't think Powell's going to come out and say bad things about markets, about the economy, about inflation. In fact, I think he's going to be pretty dang bullish on the economy, on the path of inflation, on the Fed starting the process of reducing rates. But you're priced for a lot. So markets right now are priced for 100 basis points of easing this year. There's only 3 meetings left in this year. There's September, November, and December. That implies a 50 basis point cut at one of the meetings. Now, I think we could price in 75 basis points and you know, that would be likely better for markets, because if the Fed's forced to cut 50 basis points and they have to deviate and do something larger, that's probably pricing in an economy that is weakening even further. I wouldn't go out on a limb at this point and say 50 basis points would be good for markets, but again, there's a way the Fed could kind of try to walk the markets into that and try to make it seem like a good thing. So here in just a moment, we will go over my specific expectations for what I think Powell's going to say and how I think the markets will react to this. Keep in mind, this is only my personal opinion. But first, before we do that, take a listen to what Tom Lee just said on CNBC today. This clip's about 5 minutes long, about the Fed, about data dependency, about a soft landing, and you know, what could come next for equity markets.
Well, it would be a good day for Tom Lee to be here. Joining us now is the aforementioned Tom Lee, managing partner of head of research at Fundstrat Global Advisors, as well as a CNBC contributor. A month ago, when the VIX hit 50 and there were growth fears about the economy, did you ever waver? Did you have any nights where you didn't sleep as well?
There were 3 days of horror, you know, as the market post FOMC all the way to that Tokyo Black Monday. It was gut-wrenching.
Was it? For you?
Yeah, yes. But we viewed this ultimately as being a growth scare. because we didn't think the U.S. was entering recession, which a lot of people thought after that jobs report. And I think people thought there was systematic risk because of what's going on with the yen. But markets showed a lot of resilience since then. I mean, the fact that we snapped back so sharply is showing you how strong this market is.
Still.
Yes.
The revisions yesterday, not on your radar. Should they be on investors' radar screen? I thought it might be a good thing if the job market was not as hot as people thought.
Yes, I think it is incrementally important because the FOMC minutes that came out yesterday as well showed the Fed staff saying this is a strong labor market. Well, that jobs report that came out Friday and the revisions that just came out show a lot of jobs disappeared. It's not as strong a market. And I think it gives more ammunition for the Fed to start a cutting cycle. And that's going to give a lot of life to the economy.
And to the markets.
And to the markets, especially cyclical stocks and small cap stocks.
Tech's already done well. So normally you'd think lower multiples could or at least multiples don't need to stay where they are or contract with the high multiple tech stock. So they could at least feel better about the valuations if rates came down.
Yes, that's right. I think tech is still in a good place because of AI, and NVIDIA should reinforce that. And it's not a demanding multiple. NVIDIA is maybe 28 times forward earnings, which is for one of the most important companies in the world. It's not a high multiple. So if tech is in a good place and then we get Fed cuts, I think it allows the overall market to expand.
Do we see an orderly easing cycle because the Fed doesn't feel like it needs to act intra? They have a meeting where they go 50 or whatever. You think they just 25 and then the next meeting 25, so only do 50 this year and then maybe continue next year? You think it'll be like that?
I think that a soft landing the probabilities are going up, and that's why this should be a benign cutting cycle, like good for markets. But I think the key is the Fed getting off data dependence, because data dependence is the reason they missed the inflation turn. And I think now they're missing the soft landing.
Rear view mirror. But is it possible that they're too restrictive right now and that the lag we don't know how powerful the lag effect of the higher rates could be and they end up doing 50 or doing a couple of 50s? Is that possible?
I think futures markets are showing more than 2 cuts, so I think the Fed probably is a little behind the curve, and we know there is a recession in housing and durables and auto sales, so there was a lot of pain out there. So cutting more aggressively would actually make sense, at least from the market's perspective. Where do you think,
well, you're a market guy, but where do you think unemployment tops out? Do we get to 5? Do we go over 5% unemployment?
A lot of it has to do with how the Fed communicates to CEOs, because a lot of companies are cautious, right? With monetary policy this tight and real rates this tight, it makes them reluctant to expand. And so the job market itself kind of hinges on what the Fed's doing. And yeah, it could, once the job market starts seeing unemployment rise, it could get bad.
I think Bitcoin's 60,000, give or take. Gold has been hitting new highs, obviously. I think we showed a chart the other day. Kelly was trying to tell me she had been right.
About the disconnect.
No, about gold being a bet. So we looked at it over the last 5 years, or I don't know how many years, but gold was up 90% and Bitcoin was up 13,000%.
Okay.
That was that we looked at. So I mean, gold is moving, and it's moving not in a correlated fashion with risk on, whereas Bitcoin definitely looks like it's just a
Does that ever switch?
Risk on.
I think it can. I mean, Bitcoin is just sort of got 2 functions, right? Because it is a risk-on asset, but I think it's an important protection against systematic risk.
Do you ever want it to be correlated to gold?
I think Bitcoin is digital gold, so I think it's replacing gold over time.
So eventually it should act like gold, which means that it shouldn't have the kind of meteoric rise that we're talking about here.
Well, it depends on what the dollar does, because there could be a day that dollar could debase, and then you'd want to own a lot of Bitcoin or gold. But, I mean, to me, the fact that gold's rising is showing you there's still a lot of fear out there. I mean, I think gold is almost a measure of the bearish sentiment, and that's why I think stocks still have upside.
Can we talk politics for just 1 second? Do you have an election prediction as it relates to the market? Do you think the market is do you think anything we're seeing in the markets has anything to do with what's going to happen in November?
Yes, to an extent. I think the markets are believing Trump's probabilities of winning are stronger than the polls are showing. But I think when the market sort of becomes more convinced of that, I think you'll see cyclical stocks do better, small caps, Bitcoin do better, because these are really clear policy differences. But yes, to me, I think over the last couple of days, to me, the market seems like it's betting on Trump's odds being better than the polls.
Okay. All right, Tom, thank you.
Thank you.
I think sometimes you come on later in the day. I think it's much better first thing, don't you think?
First thing. Also, he gets it out of his way. He's got the whole day.
Gets it out of his way, but it's just.
And then, by the way, his smart comments then get repeated all day.
Right.
On the air.
Right.
Goes on the afternoon.
So if you do go on later, I would say like maybe 7 or 8, but anything over 9, it's just not making sense, right?
It makes sense. I hear you.
In that clip, Tom Lee highlights, something that I talk about all of the time. Like, if we go into recession, stocks are just going to do bad in general, okay? But if we avoid a recession, big tech is not going to do well. Okay? Or I don't want to say it's not going to do well necessarily, that it needs to collapse or anything along those lines. But other areas of the markets are just going to do better. Areas that are cyclical, that means they are cyclical to the economy. That means like Tesla. If we go into a recession, Tesla's probably not going to sell as many Teslas. Okay, that's just the fact of the matter. Tesla's a cyclical company. If the economy expands, and this was actually just a rolling recession, and we can start to get wages that start to outpace inflation, and people can feel more confident and go out and spend, and people, feel like they actually have job security again, which they currently do not. Maybe get the real estate market moving. A lot of people forget there is a ton of wealth locked up in homes. Even if homes fall in price, just people being able to sell those homes and move into a new home and get a chunk of money in the bank is a very stimulative measure to the economy, okay? I think that's something I was overlooking for a while, just with how slow real estate has been. If people are able to sell and get new houses, you're going to wake up and have $100,000 in the bank. And what are people going to do? They're going to go out to restaurants. They're going to buy a new car. They're going to spend that money like basically the government does, just spending like they never had money before. Okay, so I think there are factors that could be tailwinds to our markets, to the economy, when the Fed does start to cut rates. But the one area more than others that will not benefit, is big tech. Okay, big tech has benefited from being the only source of safer growth in our markets. Higher recession odds have benefited big tech stocks, pushed up those multiples. Because where would you rather be if we go into a recession? Would you rather be in banks? Would you rather be in cyclicals? Would you rather be in, heavily indebted companies or companies that are tied to, interest rates or the economy, performing well? No, you probably want to be in big tech that really doesn't care about what happens in the economy. Big tech's going to do what big tech's going to do. They do a lot of business with other enterprise, businesses, large companies. So for all of these reasons, plus the Fed lowering rates means less interest that these big tech companies are going to make. All of these things are not necessarily good news for big tech, but will be good for cyclicals, will be good for interest rate sensitive stocks, in which Tesla fits that definition perfectly. And I think that's one of the reasons why Tesla stock sold off a bit more than the rest of the markets and other areas of the markets. Because, Tesla has the most to gain or the most to lose from a soft landing or from whatever the Fed has to say tomorrow. Now, specifically what I'm expecting from Jerome Powell is something along the lines of most members of the committee are in favor of cutting rates in September. We believe inflation is now on a path to 2%, although it's going to take time. We're on a path to 2%. There may be further weakening in the economy and the labor market. and we will approach the incoming data and the path of rate cuts as such. We will do more if we have to, and we will do less if we do not have to. So I think from that perspective, we're probably going to get everything we want to hear. A Fed that will accommodate if they need to, or take a slow and methodical, stance to cutting rates also if they have to. I don't think there's going to be mentions of, cuts at every meeting this year, right? So I think that's a potential downside catalyst for markets, since we are pricing in at least one cut every meeting of this year. The Fed's still, I think, going to rely on the data coming in. Like, I don't think the Fed's going to, oh yeah, we're on a path to 2%, we can start to cut at every meeting. I don't think the Fed's going to say that. So I think if there is an area of caution that the markets have, if we do get a larger sell-off in the coming days and weeks, it's probably because Powell did not confirm multiple cuts. I think Powell's probably going to confirm September, but November, December, I don't think Powell's going to go out and make those kind of claims. Okay, that's just my personal opinion. He might, all bets are really off the table when it comes down to Jackson Hole or really any Fed meeting. But that's what I think is going to happen. Now, how does that affect equity markets? I think we're going to get everything we want to hear besides the confirmation of multiple cuts this year. Jerome Powell is going to say we have a new SEP coming out in September. Then you'll get more information. So it's kind of punting a little bit, kicking the can down the road, if you will, not giving us too much insight while also trying to quell markets. Since the last Fed meeting, we have had this Japanese unwind, this implosion that happened, and we really haven't heard much from Powell. We haven't heard anything from Powell on that, but we haven't heard much from other Fed officials as well. And I think the Fed is going to try and convey to the markets that they will backstop things, right? If things get bad, if there's unexpected weakening, they will cut even more. I don't think the markets want to hear that, because that by then, if the Fed is cutting because they have to, because there's weakening out there, either financial stability weakening or economic weakening, or potentially both, we're probably not going to like that, because that's going to mean we're either in a recession or getting pretty dang close to one. So I think that's what we can expect tomorrow. Honestly, we've rallied a lot though in the S&P in just a short amount of time. I wouldn't be surprised if we do trend lower to this 50-day moving average. That wouldn't surprise me. That would be pretty minimal downside overall, like 1.8% downside from here to get to that 50-day moving average. I wouldn't count that out over the next couple of days. And then if we were at that level, I think there'd be a little bit more of a, balanced approach. Although I think markets are still super expensive and pricing in the best possible scenario. Multiple Fed cuts, no recession, strong economy, strong earnings. Like, are we going to get all that? I don't know. But is Powell at Jackson Hole going to be the catalyst that sends us down 10% from here? 15, 20% from here? Probably not. I do think NVIDIA earnings will be important coming next week, and it's really going to come down to each and every single data point, especially that has to do with the consumer, retail sales, durable goods orders, consumer spending data. Those are going to be the most important focal points for markets for really the next couple of months at least, until it looks more certain that, hey, we're going into a recession or we're going to have a soft landing, which I think the conclusion of a soft landing could actually take like 6 to 12 months, right? We're not going to actually know if we're going to have a soft landing until the Fed has cut rates probably 200 basis points, which could be 6 to 12 months from now, and Fed funds rates are closer to neutral. If we can get to neutral and we're not in a recession and the economy's in an okay place, then you could probably say we're having a soft landing. At that time, inflation should be 2%. That would be the we did it moment, at least here in the near term. I don't think we're at that point right now. So I don't know how much upside is left in Magnificent, 6 or Super 6, if you will. But I do think if we get upside tomorrow, it's not going to come from big tech. It's going to come from other internal areas of our markets. Small caps, consumer discretionary might start to do a little bit better, which has been the worst performing category in the S&P 500 this year. Cyclicals, value, high paying dividend stocks that are safe right now that have value. CVS Healthcare, Altria, UWM, as mortgages start to pick up. These stocks are paying anywhere from 4 to 6+%. Those areas seem like good value to me as the Fed does start to cut rates. There will be a seek for yield, in that kind of environment, and that should help out those stocks. I like those areas. I'm not a super big fan of dividends normally, but I like dividend stocks more than I like Super 6 right now or big tech. That's just factual. Like, there's not much upside left in these names in the near term. Like, Apple is priced for absolute perfection. Okay. Meta is priced for absolute perfection. Microsoft priced for damn near absolute perfection. Google, same. Nvidia, same. Why? Because we've gotten damn near perfection out of these companies for the last 2 years, or at least year. And I just don't think the tailwinds that have supported this area of the markets will continue to hold up. And I think, the bull thesis will get stronger for cyclicals, value, interest rate sensitive, companies tied to the business cycle more or less. And that is Tesla by definition. And that's why I do think Tesla underperformed today, so much relative to other names. There was also news today that BMW outsold Tesla in Europe. That is not confirmed yet. We don't have data from Poland, was it Czech Republic or Croatia, Hungary, couple other different countries as well. Should get that out tomorrow morning, and the numbers could change a little bit, but I don't really think that was a big deal. I really don't think that had much of an effect on Tesla. Let me know what you think for Fed Jerome Powell tomorrow, how you think it will affect Tesla stock down below in the comment section. In the meantime, hit the like button as well as subscribe to the channel. You guys have a great rest of your day, and I will see you in the next one.